Who really controls your money? Is it you, with the wallet in your pocket, or the account on your screen? Or is it someone else? An insane and a silent architect shaping our economic world from the shadows. Let's pull back the curtain on this grand stage and meet the main puppeteer. The central banker. This isn't just about coins and banknotes. It's about a system of immense power, a story that dictates the fortunes of nations and the financial lives of every citizen. Our story begins long ago, in a world without money as we know it. Imagine two early humans. One has a surplus of grain but needs a tool. The other has tools but needs grain. This is barter, the simplest form of exchange. But it's inefficient. What if the tool maker doesn't want grain? So humanity's found a better way. Commodity money, things that had inherent value, like salt, shells, and most famously, shiny, durable metals, like gold and silver. For centuries, gold was money. It was tangible, trusted, and its supply was limited by nature. Then came a brilliant, and perhaps dangerous, idea. Goldsmiths, the original bankers, realized that people rarely came to withdraw all their gold at once. They started issuing more paper receipts, promissory notes, than the gold they actually held in their vaults. This was the birth of fractional reserve banking. They could lend out money they didn't physically have, creating credit out of thin air. It was profitable, but risky. A sudden panic, a bank run, could bring the whole system crashing down. This repeated cycle of boom and bust, of bank failures and financial chaos, created a demand for a stabilizer, a lender of last resort. And so, the concept of a central authority, a central bank, was born to oversee the system, to be the banker's bank. Fast forward to today. The gold is gone. The money in your account isn't backed by a physical commodity. It's fiat money. The word fiat comes from Latin, meaning let it be done. Our money has value simply because the government declares it does, and we, the citizens, believe in it. This is where the magic or the illusion of modern money creation truly begins. Most people think money is printed by the government. That's only a tiny part of the story. The vast majority of money is created by commercial banks every time they issue a loan. Let's see how. Imagine a citizen, let's call her Sarah, deposits $1,000 into her bank. The bank doesn't just lock that money in a vault. The central banker sets a rule called the reserve requirement. Let's say it's 10%. This means the bank must keep $100 of Sarah's deposit on hand. It can lend out the other $900. So, another citizen, Mark, comes in for a loan to buy a new laptop. The bank lends him that $900, but they don't hand him a stack of cash. They simply credit his account with $900. Poof! New money has just been created. Mark then buys the laptop, and the seller deposits that $900 into their own bank. Now, this second bank must keep 10% $90 and can lend out the remaining $810. This process continues, with each loan creating new money that gets deposited and loaned out again. Sarah's initial $1,000 deposit can ultimately lead to the creation of up to $10,000 in the banking system. This is the multiplier effect, a cascade of credit that expands the money supply far beyond the physical cash in circulation. It's a system built on debt. For every dollar of money, there is a corresponding dollar of debt. Now, if commercial banks are the engines of money creation, the central banker is in the driver's seat, holding a powerful toolbox to control the speed. The first tool we've met is the reserve requirement. By erasing it, the central banker forces banks to hold more cash, reducing their ability to lend and slowing the economy. By lowering it, they encourage more lending and speed things up. But the most powerful and frequently used tool is open market operations. The central banker can buy or sell government bonds on the open market. When they buy bonds from commercial banks, they pay for them by crediting the bank's reserve accounts. This injects new money directly into the banking system, giving banks more fuel to create loans. This is like pressing the accelerator. Conversely, when they sell bonds, they pull money out of the system, hitting the brakes. Then there's the discount rate. This is the interest rate at which commercial banks can borrow directly from the central bank itself as a lender of last resort. A lower rate encourages banks to borrow and lend more freely. A higher rate makes it more expensive, discouraging lending. It acts as a signal, a message from the central banker about the direction they want the economy to go. And in times of crisis, like the 2008 financial meltdown, the central banker can pull out even bigger, unconventional tools. The most famous is quantitative easing, or QE. This is like open market operations on steroids. Instead of just buying short-term government bonds, the central bank buys up massive quantities of long-term bonds and other assets, flooding the financial system with liquidity on an unprecedented scale, all in an attempt to stimulate the economy when other tools have failed. This brings us to the intimate and often fraught relationship between the government and the central banker. The government has an insatiable appetite for spending on infrastructure, on social programs, on defense. Often, it spends more than it collects in taxes. This shortfall is the budget deficit, and it's covered by issuing debt in the form of government bonds. So, who buys all this debt? Large investors, foreign countries, and, crucially, the central banker. When the central bank buys government bonds, it is, in effect, financing the government's spending with newly created money. This is a powerful and controversial partnership. It allows the government to spend beyond its means, but it also increases the national debt. The national debt is the total accumulation of all past government borrowing. The central banker plays a key role in managing this debt, keeping interest rates low to make the debt serviceable. But it's a delicate balancing act. Create too much money, and you risk runaway inflation, devaluing the currency and eroding the savings of every citizen. Create too little, and you risk economic stagnation and recession. So, we return to our question: who controls your money? The answer is complex. It's a system, a dance between the citizen, the government, and the commercial banks. But at the center of it all, conducting the orchestra, stands the central banker. Their decisions, made in quiet boardrooms, unseen by the public, ripple outwards, influencing the price of your groceries, the interest rate on your mortgage, the availability of jobs, and the value of your life's savings. From a high tower, the central banker looks out over the sprawling city skyline. Every light, every home, every business is touched by their influence. It is an immense, almost unimaginable power, wielded not with armies or laws, but with the subtle, invisible levers of money creation. The next time you look at the money in your hand, remember its journey. It's not just a piece of paper or a number on a screen. It's a token in a much larger game, a game whose rules are written by a powerful few. And it begs one final, thought-provoking question. In a world governed by this system, what does financial freedom truly mean? Thank you for watching. If you found this journey enlightening, consider subscribing for more deep dives into the systems that shape our world.